Welcome back to the deep dive. Today, we're really focusing our analytical engine on, well, one specific and, frankly, pretty heartbreaking case study from the recent crypto launch calendar.
Yeah, BlockMine, BMID.
Exactly, the BMIND token launched over on the base chain. We've got a pretty comprehensive stack of sources here: block explorers, contract audits, team communications, all aimed at answering your fundamental questions. You brought us this deep dive because, well, you want to know exactly why this token, which looks, standard and secure on paper, has seen just an absolutely devastating, what was it, 92.9% price collapse. So our mission today, it's very specific. We need to get into the details. What mechanisms does this project actually have for price stability? Does the team really engage in token buybacks? And maybe most importantly, why does that price chart just look like a continuous, relentless drop since it launched?
That is the perfect mission. And, what our sources immediately show is that critical distinction. It often separates successful projects from failed ones in this space. The difference between, let's say, technical integrity and actual project viability. Was this a genuine product that just hit market rejection? Or was it somehow set up to fail? We're going to try and separate those two ideas. The analysis suggests the real forces here are less about direct fraud and more about just catastrophic execution and, well, deep structural weakness.
Okay, let's unpack this then. Let's start with the cold, hard numbers. They really define the tragedy of this BMIND chart because the reality is, well, it's startling. All right, so BlockMine launched just a few months back, right? August 31st, 2025. It used Uniswap v4 on base chain.
Yep, standard enough launch.
And it started pretty small. Initial market cap was hovering around, what, $40,000 to $50,000?
In that ballpark, yeah.
Relatively modest.
But during that initial, launch excitement, the token did manage to hit an all-time high, an AT, of roughly 0.000000000.
A brief moment in the sun.
Exactly. That brief moment, that was its peak. And the fall from that peak, it's been just dramatic and persistent. But early November 2025, so just 2 months later, the price had spiraled down to around $0.0000439.
Wow.
Yeah. And when you calculate that loss, you realize it's not just some deep correction. It's a massive, like you said, 92.9% destruction of value. And the chart, as you pointed out, it doesn't show these wild swings up and down. It's just relentless, a consistent decline.
Okay, so if we just assume for a second that the contract itself is secure, and we'll definitely dig into that in section 3, what is the continuous force just grinding this price lower every single day? Why isn't there any sign of a market bottom or, a bounce?
Well, the sources point to 5 interconnected factors. This wasn't like a single catastrophic event. It's more like a systematic market failure. These 5 weaknesses are all running at the same time.
Okay.
And they create that impression of just a constant downward slope because every single one acts like a continuous weight on the price. The first one, and honestly, I think this is the most existential problem, is the extreme illiquidity. It's coupled with critically low trading volume.
Right.
The token is basically trapped on Uniswap v4 on base chain. And the numbers, they're genuinely shocking. We're seeing 24-hour trading volume ranging from, like, a low end of $28, maybe up to $256 on a good day.
I have to stop you there. $256 in a full 24-hour cycle. That's statistically zero compared to the ecosystem it's in.
It's less than a rounding error. Seriously. When you think about base chain handling, on average, over $65 million in daily volume, BMIND's activity, it's negligible, which means the token is essentially untradeable for anyone trying to get in or out with even a, tiny retail-sized position, maybe a few $1,000s. Forget it.
And this ties directly into that concept you mentioned from the sources, the death spiral. We really need to walk the listener through that mechanism because it perfectly explains why this token just cannot find a floor.
Absolutely. The death spiral, it's a liquidity trap. Here's kind of how it works. When the market depth is almost zero, like here, any trade, even a tiny one, creates a huge price impact. We call that high slippage. So let's just imagine a typical small investor. They decide, okay, I want out, and they try to sell, say, $500 worth of BMIND. Because the total available liquidity pool is so shallow, so thin, that $500 sale could instantly crash the price 10%, 20%, maybe even more.
Wow.
And this creates a self-fulfilling prophecy. It's all about fear. Traders look at the chart, they see the volume is non-existent, and they realize, hey, if I buy a big chunk of this, I'll never be able to sell it without causing a crash myself.
So they stay away.
Exactly. This fear of being trapped, of not being able to exit, it discourages any new buyers, which of course ensures the volume stays incredibly low. Low volume leads to high slippage, which feeds the fear, which guarantees the volume remains low.
It's a closed loop.
It's a closed loop that ensures every single exit, no matter how small, just pushes the price further down the drain. No escape.
Okay, so that's structural reality. It then contrasts really sharply with the second factor you identified, this huge gap between what the team initially claimed and the actual post-launch market reality.
Yeah, this one's important. The Solberg Invest team, they presented some promising metrics during their beta test back in August 2025.
What did they claim?
They claimed 150 daily users, and they reported $145,000 in trading volume generated just during that initial testing phase. Now, those are metrics that, they promise a solid foundation.
Sounds decent.
But the source analysis reveals a really stark reality check. Post-mainnet launch, so after September, there's just no evidence of growth at all.
Ouch.
Which points to a massive failure of transition. Either those initial beta users were just, test accounts, maybe friends and family, or maybe more likely, they were speculators who bought into the initial hype.
And then dumped.
And then dumped immediately once they realized the token had no actual utility or momentum behind it. The whole adoption thesis, the core idea that generated those initial volume numbers, just evaporated instantly upon deployment.
Okay, next. We hit that classic market hurdle for basically any microcap token, the complete lack of centralized exchange listings, CEX listings.
Right. BMIND is stuck entirely within the decentralized exchange, the DX ecosystem. Now, look, this is common for a fair launch project initially, but it creates this enormous barrier to entry. CEX listings matter. They provide massive exposure, simple fiat on-ramps, and crucially, access to institutional money and those high-volume retail buyers who just won't mess with connecting wallets to base chain DXs. It's too complex for many.
Yeah, it's a different world.
It is. And most tokens that have any kind of long-term viability, they usually manage to secure at least one CEX listing, even a minor one, within maybe 3 months of launch. BMIND's continued absence, it suggests either a failure to get institutional interest, or maybe even more damningly, that the project just doesn't meet the basic listing criteria. Things serious exchanges look for, like sustained volume and actual development.
So it stays trapped.
It forces the token to remain trapped in that illiquid, highly volatile DX environment we just described. Nowhere else to go.
And the fourth factor seems like the logical outcome of the first three, then. There's just no evidence of organic development activity from the team. It feels like the project just went silent.
In crypto, silence often equals abandonment. And abandonment just accelerates the illiquidity problem.
What do you look for?
We look for public records, right? GitHub updates showing code commits, developer roadmaps being updated, growth milestones being announced, active engagement in, like, Telegram or Discord channels. Our sources indicate minimal recent communication from the Solberg Invest team after the launch.
Yeah.
It really suggests they might have spent all their resources on the launch itself, getting the contract ready, drumming up that initial hype,
And
then simply ran out of steam. Or maybe belief, or funds. This lack of visible momentum, that's the clearest signal to any remaining investors that the project has stalled, which leads to natural, continuous exits. People just give up hope.
Okay, and finally, we have to acknowledge the sort of structural factor that maybe made this collapse almost inevitable. General crypto market dynamics, specifically around the fair launch model.
Right. BMIND followed that standard fair launch playbook, 0% team allocation, launching through mechanisms like Clanker. Now, while this is often praised, it's decentralized, it's secure,
Yeah, sounds good.
it carries this profound structural disadvantage. The initial trajectory is almost always the same. Euphoria at launch, followed by rapid deterioration as the early speculators, the flippers, sell into the open market.
So what's the key disadvantage there?
A key here is the lack of team incentive and critically financial reserves. Because the team took 0% allocation, they don't have this vast treasury of tokens they can sell to fund marketing or development or partnerships.
Right.
Nor do they have a massive vested financial interest, maybe outside of a philosophical one, to step in and aggressively buy back tokens to support the price.
So when the sellers come,
When the speculators exit, there's no large financial entity, meaning the development team stepping in with a war chest to stabilize things. This design, yes, it prevents a classic rug pull.
which is good.
Which is good, but it also virtually guarantees a slow, painful bleed out if the product doesn't instantly achieve massive viral adoption.
Yeah.
And most don't. Which brings us really nicely, actually, right back to your core question for the listener. When a project is collapsing like this, what mechanisms are actually in place to provide stability? And critically, that question you asked, does the project buy back its own tokens?
Yeah, let's tackle that buyback question head on. The tokenomics, they seem to promise some kind of stability mechanism. Does the Solberg Invest project actually buy its own tokens to prop up the price?
Okay, so theoretically,
Yeah.
yes, they have a mechanism designed for it. Practically, the answer is a definitive no.
Ah.
This is the absolute definition of a tokenomics mismatch. The token design assumes that platform fee generation specifically, there's a 0.5% fee on all trades done through the BlockMine platform. It assumes that fee will generate enough revenue to drive automatic buybacks and price appreciation. That's the theory.
Okay, so the entire stability structure relies on the idea that people are actually using the product a lot,
Yeah.
generating high volume transactions.
Precisely. The value accrual for the token, it's purely theoretical. The BMIND token itself offers almost no tangible utility. Maybe some vague governance features down the line, but nothing concrete. Its entire worth depends on the platform generating fees. So if the platform isn't being used, the mechanism fails at step one. It never even gets started.
And based on that extreme illiquidity we just talked about, trading volume measured in like hundreds of dollars,
Yeah.
we can probably safely conclude the platform is generating, what, maybe a few dollars in fees per day at best?
That's the grim reality.
Yeah.
Minimal adoption equals negligible fee generation. Therefore, no buyback support is actually happening, period.
Oh.
Even if the team wanted to stabilize the price, that 0% fair launch structure means they lack the external financial reserves or a big token supply to inject funds for, say, sustained marketing or direct open market buybacks.
So they can't step in.
They launched a token that was structurally incapable of generating its own support system once the foundational product failed to gain any traction. It was doomed from the start if the product wasn't an instant hit.
They did, though, implement another layer. You mentioned this internal stability thing using the dynamic fee system via Clanker v4. We need to dive into that. What was that supposed to do, and why did it maybe end up working against stability during the collapse?
Right. The intention here was technically sound. Clanker v4, the platform they used, allows for a dynamic fee structure.
Okay.
The contract has a base swap fee, it's around 1%, but it's programmed to scale upwards, potentially quite steeply, usually during periods of high volatility or, price collapse like this.
And the goal?
The goal is to act like a governor, right? To make rapid, large sales extremely expensive. The idea is to disincentivize dumping and maybe smooth out the volatility, protect the price floor a bit.
Sounds logical.
But this creates a really profound paradox that we have to talk about. While it's technically perfect in how it works, this scaling complexity can actively suppress legitimate, needed trading activity.
Oh.
Well, if the price is collapsing, the fee scales up to, I don't know, let's say 5% or 7%. That kind of punitive fee structure discourages the very people you need in that situation. Sophisticated traders, maybe whales, who might otherwise step in to provide counter liquidity. Buy the dip and stabilize the token.
Because the fees eat their potential profit.
Exactly. They look at these excessive fees, and they see it as just reducing their potential profit margin, adding significant risk. So they just stay away. Why bother?
So the security measure designed to stop the massive dumps actually ends up discouraging the large buys needed to stop the dump in the first place. It's like an intellectual solution that just failed when faced with real market psychology.
That's a perfect summary. It solved a technical problem, maybe, but it actually amplified the market problem. And furthermore, we have to raise a red flag about the fee distribution opacity. This directly impacts trust and any future stability prospects.
Okay, let's break down how the fees are distributed. Assuming, again, hypothetically, that they actually collect any significant fees.
Right. So the source material shows the swap fees collected on the platform, they get aggregated in WETH. That's wrapped ether, just the standard medium of exchange on base chain.
Got it.
That WETH is then supposed to be distributed three ways. 20% goes to the Clanker protocol itself, that's their cut. 25% is automatically added directly back into the liquidity pool.
Which is good, right? Helps the cool.
Which is positive, yes. Good for sustainability in theory. And then the rest, the remaining 55%, is earmarked to fund operations.
Okay, that phrase, the rest to fund operations, that immediately makes my ears perk up. Where does that money actually go? Is it defined?
That is the critical ambiguity. This clause lacks any transparency. It doesn't say how much of that 55% the Solberg Invest team captures as, say, income or salaries versus how much is truly reinvested into marketing, partnerships, future development, whatever.
So it's a black box.
Pretty much. In transparent DeFi projects, this kind of fund is usually routed to something visible, like a community treasury, maybe DAO controls it, or at least a multi-signature wallet where the public can see the transactions.
But not here.
Not specified here.
Yeah.
And the lack of this clear mechanism, it just destroys investor confidence in the project's long-term sustainability. If you, as an investor, can't verify that any fees generated will actually be used to stabilize the token or fund growth, and instead you suspect it just funds the team's lifestyle. Well, you have no reason to stay invested, right?
Makes sense.
The opacity here, it's a major structural failure when it comes to long-term viability and trust.
Okay, so we've pretty much established the market failed because of, well, illiquidity and some serious execution mismanagement, but now we have to tackle the big fear. The one that always comes up in a 92% collapse. Was this engineered? Was it just a scam, a rug pull waiting to happen? And this is where it gets really interesting, because the contract integrity, it tells a completely different story from that price chart.
Indeed, this is crucial. The contract integrity of BlockMine is surprisingly quite robust. It's actually the defining feature that prevents us from just calling this a straightforward fraud case. This level of security directly mitigates the most common ways teams steal funds in crypto.
Okay, break down those strong security characteristics for us.
All right, first, and maybe most fundamentally, the team executed renounced ownership. This is verifiable on the blockchain. The contract ownership was immediately set to the zero address that's 0x0000, all the way to 00 right after launch.
Then that's the gold standard.
That is the industry gold standard for establishing trust. It's a permanent action.
Okay, walk us through the specific implications. What exactly does renouncing ownership prevent the team from ever doing?
It prevents all the catastrophic administrative actions. The team cannot mint new tokens out of thin air, which eliminates the risk of just inflating the supply to zero.
Huge.
They cannot modify the token parameters later on, like suddenly changing fee structures to trap people. Critically, they cannot freeze user wallets. They can't block transfers. They can't just stop trading if things go bad for them.
So the contract is locked.
The contract is immutable and autonomous. It runs itself according to the original code. This security measure categorically eliminates the potential for a centralized malicious update or a token freeze. Those are the absolute hallmarks of a low-effort scam token.
Okay, that's significant. What else?
The second major safeguard is permanently locked liquidity. Remember that initial seed capital? The $30,000 to $50,000 they used to create the first trading pool on Uniswap?
Yeah.
That was locked permanently in the Clanker LP locker mechanism. And furthermore, the LP tokens, the receipts proving ownership of that liquidity, those were burned, sent to an unrecoverable address.
Meaning?
Meaning the creators cannot, under any circumstances, pull that initial capital back out of the pool. That money is permanently dedicated to supporting the BMine Wealth trading care on Uniswap. No rug pull possible on the initial liquidity.
Wow, okay. So the project passes the really stringent security test then.
Wow.
No ability to mint tokens, no ability to freeze trading, and no ability to rug the initial liquidity. Technically, this contract is sound, secure.
It's a standard, secure ERC-20 token contract. No hidden backdoors, no special privilege functions for the team, and that 100% allocation went straight to liquidity at launch. Very clean from a security perspective.
But there's always a but. Where does the governance weakness come in then? You mentioned something about a promise.
Right. The weakness lies in a promise that was tied to, frankly, unrealistic success metrics. The team's original documentation, their white paper or website, promised a formal protocol governance handoff.
Okay. What did that entail?
They explicitly stated that once the liquidity pool grew to $300,000, then two things would happen. First, the 25% fee allocation we talked about would be redirected away from the LP pool and towards community-led marketing initiatives.
Interesting.
And second, administrative control, whatever residual control they held over non-token functions, would be permanently and entirely renounced. That was supposed to be the final step towards full decentralization.
That sounds like the path to true decentralized integrity. So what was the failure point? Why didn't it happen?
The failure point is just simple math. The liquidity pool never got anywhere near $300,000. Our best estimates place its peak value at only maybe $50,000 to $100,000 briefly before it started collapsing.
So the condition was never met.
Exactly. Because the project failed to scale to that, honestly, somewhat arbitrary financial threshold, that entire commitment just became moot. It's irrelevant now. The governance handoff hasn't happened. And critically, the team retains control over whatever administrative functions they still had, including the ambiguous handling of that 55% rest to fund operations fee stream, however small it might be.
Okay, so let me synthesize this. The contract code is perfectly secure, preventing outright theft. But the project's failure to achieve market momentum prevents that final step of governance handoff, which leaves the project in this kind of suspended, centralized animation state, which further erodes trust.
That's exactly. Security is high, but viability and trust in a long-term plan, very low.
Okay, that brings us to our final and maybe the most critical assessment for you, the listener. Is the Solberg Invest team directly responsible for this 92% price collapse? Was the team the core problem here?
We have to give a bit of a nuanced answer here. Looking at all the factors, we'd probably apportion blame, say, roughly 50% to 70% towards the team's execution failure. The West is likely due to those structural and market conditions we discussed.
So mostly team, but not entirely.
Right. They seem guilty of poor project management and pushing a flawed product thesis, but probably not outright fraud based on the contract security. Let's start with the team responsibility factors.
Hmm.
First, the overpromise on adoption. We keep coming back to those beta metrics, right? 150 daily users,
Yeah.
$145,000 volume.
Yeah.
The team launched the token based on the assumption that these initial numbers were sustainable, that they were real indicators of product market fit.
Which they weren't.
Clearly not. When those metrics completely failed to translate into any post-launch retention or growth, it demonstrated a really profound misunderstanding of their own market, or maybe just the speculative nature of their initial user base. They misread the signals badly.
And their operational response to that market rejection, that immediate failure, it was the absolute wrong one, a critical lack of post-launch momentum.
Exactly. When your token drops 92% in 2 months, that signals the team either didn't have a plan B ready, or they simply lacked the resources, maybe the willpower, maybe the belief to actually execute it.
They just stopped.
They failed to maintain any visible development activity. No new marketing campaigns were launched. No new partnerships announced after that August 31st launch. In the attention economy of crypto, especially for small caps, going silent is a strategic catastrophe. Investors just interpret it as the team abandoning ship.
Okay, now we have to really dissect the core idea, the thing that held this whole theoretical structure up, the unclear product market fit, the BlockMine core value proposition. It was allowing users to trade crypto over email. On paper, maybe it sounds convenient, I guess, but fundamentally, this whole thesis seems like it was destined to fail, wasn't it?
It really seems that way. The failure is both technological and psychological, I think. For a market as volatile and incredibly time-sensitive as crypto, email-based trading fundamentally lacks the real-time responsiveness you absolutely need.
Can you elaborate?
Sure. Imagine trying to execute a trade. You send the email instruction, but then you might get the confirmation email 3 minutes later, or maybe longer, depending on servers.
Yeah.
In crypto, the price could have shifted wildly in those 3 minutes.
Yeah, that's ancient history in crypto time.
Exactly. The inherent latency in just basic email server transmission makes it completely impractical for executing trades on volatile, fast-moving assets like altcoins.
Yeah.
It's just the wrong tool for the job.
It sounds absurd when you put it like that. The convenience of using email, whatever that might be, surely doesn't outweigh the fundamental need for speed and low latency in trading. I'm picturing someone sending a limit order via email, only to get the confirmation hours later, long after the price is blown way past their entry point.
It creates a dangerous and, frankly, unusable user experience for serious trading. And moreover, BlockMine's other features things like portfolio tracking, advisory services. They're completely commoditized. Meaning dozens of established platforms offer those things, often for free, and they do it with superior low-latency app interfaces. Way better user experience. The team failed to identify any true differentiator that made their novel but ultimately flawed email approach necessary or even preferable to existing faster solutions.
So they built a solution.
He built a solution for a problem that probably didn't exist, or at least didn't need that specific email-based answer.
Okay, now let's balance this, like you said. Talk about the factors that were maybe more structural or externally driven, the ones that account for the remaining 30% to 50% of the decline.
Right. We absolutely have to reconsider the structural flaw of fair launch dynamics.
Yeah.
As we mentioned, while it's great for security, that 0% team allocation meant there was no built-in financial incentive or war chest for the team to stabilize the price when things got rough.
Right, no safety net.
It forces the project to rely purely 100% on organic adoption right from day one. And when that organic adoption fails, as it did here, collapse is almost inevitable because no single entity is strongly incentivized to hold the line and buy the dips.
And the timing. They launched right into the eye of a hurricane, didn't they? Market saturation. You said late August on base chain was peak mania.
Absolute peak velocity. We're talking over 100 new token launches per day on base chain around that time.
100 a day, wow.
That level of noise, that sheer volume of new projects, meant BMIND had virtually zero chance of standing out from the crowd. they launched a complicated, arguably slow-moving trading solution straight into a frantic, hyper-speculative environment full of meme coins and quick flips.
Terrible timing.
Terrible timing, a structural disadvantage from the fair launch, plus it launched during a general market cycle that was characterized by consolidation and altcoin underperformance overall. It just created this incredibly unforgiving environment where any minor execution flaw, and BlockMine clearly had major execution flaws, was instantly and brutally punished by the market.
Okay, so the final word on accountability is complex. The team launched something technically secure, maybe legitimate in intent, but they were guilty of some severe mismanagement, poor resource allocation, and fundamentally misunderstanding their own product-market fit. This led to a stalled project, a failure, not necessarily an intentional scam.
That sums it up well. Execution failure, not contract failure. Hashtag outro.
So if we connect all this back to the bigger picture for you, our listener, BlockMine is really a textbook case study. It shows exactly why investors must separate security analysis from market viability analysis.
Two different things.
Totally different things. The project did everything right on the contract side, renounced ownership, locked liquidity, prevented theft, thumbs up there. But they failed basically everything on the market side: poor execution, a flawed product thesis, and just non-existent post-launch momentum or communication. The contract integrity, it's intact, but the entire investment thesis, completely broken, which led directly to that devastating 92% loss.
Okay, let's quickly circle back and review your original questions now that we have all this context from the sources. First, do they buy back tokens?
Theoretically, yes, using platform fees. Practically, absolutely not. Minimal adoption means basically zero fee generation, and the team has no independent reserves to start supporting the price anyway. So, no.
Second, how do they ensure stability? Well, they ensure passive security against scams. No rug pulls on initial LP, no freezing wallets. That part is strong. However, they lack any active market stability measures. And that dynamic fee system, it actually worked against stability by suppressing needed liquidity. So very little active stability.
And third, why the relentless chart decline?
It's those 5 interlocking factors working together. Crippling illiquidity, making exits impossible without crashing the price, the total failure to retain any of that initial beta adoption, the lack of crucial CEX listings, keeping it isolated, the visible team abandonment and silence post-launch, and finally, that structural weakness inherent in fair launch tokenomics when it's paired with a failed product. A perfect storm.
So for any investors out there still holding BMID, the reality presented by these sources is pretty stark. The project should probably be treated as a complete capital loss unless, and this is a big unless, there is sudden, visible, documented evidence of major team changes, significant feature pivots, or a massive, sustained marketing effort.
None of which is currently visible anywhere.
Right. Treat it as a zero until proven otherwise, basically. But let's leave you with one final kind of provocative thought to mull over. The sources did quietly mention this regulatory uncertainty around BlockMine's core function, trade crypto over email. They are technically executing transactions on behalf of users. That could be seen as acting as an intermediary, maybe even needing brokerage licenses. They managed to avoid all that scrutiny, probably just by being small and failing. But if this model had somehow, against all odds, succeeded, if it had scaled dramatically, how quickly do you think this project's inherent lack of formal regulatory compliance would have brought it under severe scrutiny from regulators, completely, regardless of how robust its underlying token contract was?
That's a fascinating question. It's possible that the project's failure, ironically, was the very thing that saved the team from potentially much bigger legal headaches down the road. Failure as the ultimate unintentional defense mechanism against regulatory crackdown.
Indeed. Something to think about. We'll catch you next time for the next deep dive.